Today we are going to explore the true range, volatility indicator that measures the overall volatility in the market. And to do so, this indicator makes three calculations and chooses the bigger number out of it. So what are these calculations? The true range has basically three formulas. One, current high minus the current low. Okay? How big this current daily bar or weekly bar or 4-hour chart bar is, the size of it. The second calculation is the previous close, either if it's a daily bar or weekly bar or 4-hour chart bar, minus the current high, okay, the absolute number of it, of course, the number of pips, and the previous close minus the current low. Again, the distance of that. The highest number of the three shows the true range and the true volatility currently happening in the market conditions. And traders use that in various ways. It's less for a technical call for execution, trade execution. It is more to present what current market conditions, what is the market phase at the moment, and based on that to estimate your risk. Okay? How far should be your protection be, and what sort of market conditions you actually are. So where is this indicator, and let's see how it looks like and compared to the market conditions. You go to the indicator section, volatility, and the very first one is going to be the true range. Okay, you can of course predefine your style and thickness of the line, and as well choose the visibility on what time frames and chart types you would want to see this indicator. So what you will see here, that in most of the time, like the market is usually in quiet range, but calmer range, right? But sometimes, boom, the market explodes, something happens. Geopolitical, fundamental, news, data release, and so on and so on and so on. So when you will see that the market is going in calm stages, that means, of course, the market will go up and down, but in smaller candles. And you would see usually in these days or in these bars, the market would have smaller size of candles, smaller bodies, maybe bigger wicks, bigger spikes. But then at some point, boom, you can see the volatility increases here, right? All these cases. What does that mean basically, and how does that look like? So, for example, look at this candle here. Okay, let's enlarge it a little bit so you would understand. If the true range read is about 82 points, you can say 00082. That means out of the three calculations, current high minus current low, or previous close minus current high, or previous close minus current low, it gives us, for example, here, right, from the high to the low, this is 82 pips, and that's the read of the true range we have, 00082. Okay, so that means that's the current level of the volatility, and you can consider that as increasing range of volatility of price ranges at that very bar. So when you determine trading opportunities based on whatever your techniques is, for example, imagine you have low, high, low, lower high, and then a breakout. That breakout happens to be with increased volatility, a very strong sign. But when you would want to consider your protection, it's not going to be as all the bars before here, which used to be, for example, 30, 40 points. Now it's going to be bigger range, which is going to be approximately around the 80 points. And that's how traders love estimating with this indicator the size of the protections they will need And many traders prefer to trade exactly at that moment after volatility increases. After that happens, of course, the numbers will start to slowly drop. But when that happens, the volatility comes in the market, the buyers or sellers take the control, and many times it causes these big moves right after that. So you can see many times, like in this example we saw, that means the volatility comes in and buyers or sellers taking the control. It's a great read when it comes to joining with the breakouts. When the breakout happens, that means there is a great chance volatility increases, but it also happens to understand when a potential reversal comes in place. For example, in here we have sequence of lower highs, lower lows, and look how it happens. The first push down, big volatility. The second push down, bigger volatility. Third push down, even bigger. But then we start to decrease, you can see here. And then when it flips, right, boom, volatility is bigger again and brings the reversal. So all this increased volatility can indicate where the momentum goes or shifts, and also helps you to determine the current range in the market and help you setting up the relevant protection. And if you enjoyed this video and would like to enjoy more trading insights, trading tips, indicators, so much more, make sure you follow this channel.